Hello, my name is George Henderson. I'm a shareholder with Fleischman and Company, a local CPA firm here in Tucson, Arizona. And we are here today to do a presentation on basic financial statement preparation and forecasting. Joining me and assisting me today is Eric Manival, also with Fleischman. Eric has been with Fleischman about 10 years and is one of the foremost experts in some of these topics that we're talking about today. The workshop objectives for today is to provide the following: an introduction to and use of the basic financial statements, which are the balance sheet, statement of income, and the statement of cash flows, and the related notes that go with those financial statements. We also are hoping to give you an overview of some forecasting methods and some strategies to forecast revenue, expenses, and financing for startup ventures. So any set of basic financial statements is going to include four things in order to be in compliance with generally accepted accounting principles, which is very critical for startup ventures that are looking to obtain either financing or investing. It's a balance sheet, a statement of income, statement of cash flows, and notes to the financial statements. Balance sheet is oftentimes referred to as a statement of financial position. The balance sheet objective is to take a snapshot of the business's financial condition at any specific moment in time. So rather than it being an indication of where the company has gone from start of a period to an end of a period, it's a picture of what a company looks like at a specific point in time. It consists of assets, liabilities, and owner's equity. Basically, assets are the items that you would have: cash, receivables, equipment, inventory, depending on the nature of your business. Liabilities consist of things like accounts payable, accrued types of expenses for payroll, sales taxes, anything along those lines, and potential lines of credit, debt, agreements, those types of things. And the owner's equity or stockholder's equity is the amount that is left over, the residual at stake, that the owners have in the company. It could be the retained earnings if you're a C corporation. It could be your capital accounts if you're in a limited liability corporation or a partnership. So at any given time, the assets must equal the liabilities and the owner's equity. That's how the balance sheet stays in balance. So basically, the balance sheet answers the simple question: what assets and liabilities do we have? And why is that important? Well, if you're a financial institution, the assets are important because that serves as a collateral for the loan. Liabilities are important because that represents other claims against those assets, potential claims against those assets. If you're an investor, the assets are important because that's the items that you expect will generate a return one day. The statement of income, which is otherwise or sometimes often called the profit and loss statement or a statement of operations, is the second key component to the financial statements. Summary of the company's profit or loss during the period is given in time, at a period in time. So this is the point that measures performance of the company from a start point to an end point. Generally speaking, that's a year once a company is up and going. In development stage companies, sometimes that is an extended period of time during the entire development stage, which we've seen run as long as 2 or 3 years for certain companies. We track the revenues and expenses so that you can determine the operating performance of your business over a period of time, and the statement answers the question, did we make money? So also very important to the investors and the financial institutions that might be lending. Are you being profitable? Is there going to be something left over? Is there going to be a return on that investment one day? The third component to the financial statements is the statement of cash flows. This reports the cash generated and used during the reporting period. It also covers a year, or if it's a development stage company, covers the same period as the statement of income. It's reported into 3 different segments. It defines how a company performs in terms of operating activities, investing activities, and financing activities, how cash is generated or used in each one of these activities. The statement answers the basic question, how did you spend or earn your money? One of the things that we find important about the statement of cash flows for small companies that are going to be doing forecasts and projections is that oftentimes what really interests the investor is a projection of future cash flows or the statement of cash flows. That's what is going to provide them some assurance or some way of measuring future cash availability to provide them as some sort of a return, a dividend, or some sort of return on their initial investment. So the statement of cash flows, going into it just a little bit deeper, again, divides activities of the company into operating, investing, and financing. Operating activities are generally the actual conduct of the business. So whatever it is that the business is, whether it's a manufacturer, a medical practice, a dental office, or a real estate office, they're engaged in some sort of operation to earn money. So the operating income is always the starting point for cash flows. And then changing in those operating assets and liabilities, and how do they impact the cash generated from operations. So for example, you could have $100,000 of net income, but if you have accounts receivable and your accounts receivable went from $50,000 to $200,000, you haven't necessarily generated any cash through operations. Essentially, you've used cash in your operations because the accounts receivable are not collected and converted into cash yet at our measurement point. So one of the other things that we have to do with operating activities is we have to take a look at anything that is charged to a GAAP basis financial statement that is a non-cash expense, like depreciation, amortization, a gain on sale of an asset or a security. Those types of items get adjusted back to the net income, since they are a charge to income but don't necessarily use up any cash. Companies also can generate or use cash in their investing activities. So generally speaking, this would be anything that is a non-current asset on your balance sheet. So property and equipment, buildings, equipment, machinery, office furniture, all these types of things are items that a normal operation or organization will have to acquire, and it uses cash up to do that. So it could also be making loans. Those are uses of flow. That's a use of the cash. All of these are comprised into investing activities. The third category for cash flows is financing activities. And this is something that we quite often see in startup companies, a lot of action in the financing activity section. You can have positive cash flow coming in from obtaining debt, loans, lines of credit. Sometimes the cash inflows are coming from the owners by either loaning the company money or actually initially investing in the company. The uses of cash that come through the financing activities as companies become more mature is to repay these loans. That uses up cash. Pay down lines of credit. That uses up cash. Paying off distributions or dividends to the owners. That uses up cash. So in a typical startup company, what we tend to see is negative cash flows in the operating and investing activities, positive cash flow in the financing activity. So as the company is building up and getting started, generally speaking, its owners are subsidizing it by providing financing inflows in excess of the needs for operating and investing expenses. As companies become more mature, the ideal picture would be to see kind of a net on the investing activities, so not necessarily spending a lot of money on those types of assets. Positive cash flows from operations that provides the money necessary to repay those financing obligations and the returns to the owners. The fourth component of the financial statements are the footnotes or disclosures. And these are generally a key component of the financial statements. These are the items that a bank or bonding company or a serious investor is going to get back into and really looks through to get detailed information about the representations that are made on the balance sheet, income statement, and cash flow statement. So one of the requirements is all significant accounting policies have to be disclosed. Generally speaking, you always see that in the very first paragraph or first set of financial statement notes. We have to describe the company activities and their relationships. So what is it that this company does? Where does it operate? What's the geographic area? How long has it been in business? What's it trying to do? Relationships, are there any other related parties or significant other entities that it's involved with that must be disclosed? It's, sometimes there could be a sister company, a subsidiary company, it could be a subsidiary of another company. All of these things have to be disclosed. The components of the inventory, are they finished goods? Are we acquiring materials that we are just basically consuming in a research and development mode? Are they just raw materials? Or is there a work in process component that's going on? How do we account for that inventory? How do we determine what it's worth from a financial statement perspective? We have to disclose the accrued expenses and all the detail of the debt. Who do we owe money to? How much? What are the interest rates? What are the maturities? What are the current terms to repay this debt? Any kind of related party transaction, either whether we're selling to a related party, we're buying from a related party, we rent property, we rent our facility from a related party. Anything along those lines has to be disclosed so that the investor or the finance company, again, can make informed decisions as to how important is it that how important are these relationships to the continued success of any enterprise or startup company. And then commitments and contingencies are kind of off-balance sheet things sometimes. Maybe we've entered into a lot of leases. They don't qualify for the types of leases that have to be set up as assets and liabilities. But we have a 5-year commitment to rent property from a certain facility, or for certain facilities from certain landlords. Contingencies, we could be a startup company that is heavy into trying to develop a process, and there could be potential patent infringement charges coming against us. All those types of things need to be disclosed. Whether or not they need to actually be accounted for in terms of setting up financial statement obligations on the balance sheet falls under some pretty complicated rules, but you do need to make the user of that financial statement aware. Basically, two basic forms of accounting that we'll see in startup companies, either accrual basis or cash basis. Cash basis is adjusted for timing differences to match up expenses and revenues in the accrual. Basic way of thinking about that is revenues get recorded in the period where they are earned as opposed to the period in which the cash is actually received. In order for your financial statements to be GAAP or generally accepted accounting principles in the United States, they have to be on the accrual basis. So you must have receivables, payables, inventory, those types of items have to be recorded on the accrual basis. A lot of times for startup companies, it's not really necessary to go through that more complicated set of accounting rules, and you can just report on a cash basis, or sometimes people consider the income tax basis cash basis. Oftentimes they marry up fairly close to each other, although there can be some nuances, some differences amongst the two. But cash is obviously based on the actual cash receipts and cash expenditures of the company. Generally speaking, it is not going to be GAAP, and the accountant's report, if you use a third-party independent CPA, will state so in their accountant's report that your financial statements have not been prepared using generally accepted accounting principles. Uses of the financial statements can be many. Management can use the financial statements as a form of internal reporting, internal record keeping, their own measurement statistics and metrics. Banks use the financial statements primarily for decision making as to what kind of credit are they going to grant to you. Investors use the financial statements to learn about the company, to measure their risk, to measure their desire to invest, or to invest further. Potential investors use the financial statements for the very same reasons. And other types of uses could be potential acquisition, merger activity. There can be internally prepared financial statements and externally prepared financial statements. Internal reporting, basically management prepares. Oftentimes small companies just have their records set up on QuickBooks, and they will print the basic formatted financial statements that come out of QuickBooks and distribute those, and those are internal management reporting financial statements. External reporting financial statements are generally prepared by a CPA firm. Could be prepared in some cases at lower level financial statements can be prepared by bookkeeping services or other accounting firms. But but CPA firms are generally used to perform audits or reviews, and more times than not on external reporting, people think of CPAs. One of the benefits of using an external reporting when it comes to dealing with a bank or a potential finance or investor, financial institution or an investor, is simply that there's an element of credibility that comes with a CPA prepared financial statement. Basically, a CPA can prepare 3 different types of financial statements for you: audited financials, reviewed financials, or compilations. The basic financial statements that we talked about with the balance sheet, income statement, cash flows, and footnotes, in order to be in compliance with generally accepted accounting principles, all look exactly the same. So the disclosure requirements, the measurement requirements, everything is exactly the same. The difference between the audit, review, and compilation is based on what the CPA does. In a compilation, our requirements are basically to get your internal information, look at it, ask questions if something does not appear appropriate or correct, make necessary adjustments along those lines, and then put your information in the form of financial statements, and that's called a compilation. So no level of assurance or that the accuracy of the numbers and no checking on those numbers is required in a compilation. A reviewed financial statement is a little bit more in scope. It includes us making certain inquiries of management and others that have any role in the financial reporting responsibilities of the company. We run analytical tests and procedures on those numbers, measuring the company up to its historical performance and also measuring it up to other companies in the industry. And then the audited financial statements is essentially where we seek outside corroboration of any financial statement number that is material on your financial statements and needs to be presented as such. So rather than taking your word for, I guess if you look at it in terms of a category on a balance sheet, if you took a basic accounts receivable in a compilation, we would basically just make sure that your accounts receivable added up, didn't have anything inappropriate looking in it. In a review, we might actually test the aging of those accounts receivable, making sure that that your receivables aren't aging, getting so old that we doubt that you're going to be collecting them, or there could be any doubt that you're going to be collecting them. In an audit, we might actually try to send confirmation outside the company directly to your customer and ask them to corroborate the fact that, yes, in fact, they do owe you that amount of money at the balance sheet date. So that's kind of a basic difference between the audit, review, and compilation services. The next item that we were going to talk about is some basic forecasting issues, and for that, Eric Manival from our firm is going to take over.
Hi, I'm Eric Manival. Like George said, I'm a senior manager at Fleischman. I've been with the firm since 2004, and I specialize in the areas of audit and accounting, equity transactions, healthcare, and then science and technology startups. What George has been talking about really has been historical financial information, and the rest of the talk today in this program will be talking about future financial information, forecasts, and projections. Those are the two available formats to discuss this information in. And there's really a couple of different presentation models available. One that really mirrors what George was talking about in that it provides a set of financial statements, and a second that really talks more just on cash flows. The difference between a forecast and a projection: a forecast is a prospective financial statement that presents an entity's expected financial position, whereas a projection really is a financial statement that talks to a hypothetical situation. What do I really mean there? A forecast is the results of the operations of your business that you're expecting, and a projection is the results of the operations given certain hypothetical conditions. So a forecast would be, here's what I think my sales are going to be next year. You can forecast that out. A projection would be, here is what I feel my sales will be next year if I take out this loan, or here's what my sales will be next year if I get this type of equity financing. Talks about different hypothetical scenarios, and you can lay that out for your potential investors and your potential creditors, or your existing investors and creditors. A forecast or an assumption, regardless of which method you use or which format, really requires a tremendous amount of assumptions made by management. It's predicting the future. No one can do this accurately. There's a lot of assumptions involved, and there'll be disclosures noting those assumptions. So because there are so many assumptions, you really want to make sure that you're only putting these documents in front of people who really understand what they're looking at. So you'll want to restrict the financial statements as to their use. You can provide them to your potential investors and build that into the actual model so that they know that what they're getting, they see it, they understand that. And like I said before, a complete set of financial statements does not have to be produced. When you're forecasting or preparing a projection, there's really 4 key things that you need to consider: revenues, expenses, investing, and financing. Of the 4, really the most important critical element is the revenues. You need to determine how much of your product you're going to be selling. Once you know how much you're going to be selling, you can figure out how much it's going to cost to make it. That's when you pin down your expenses. And also your investing. What do you need? Will you need to buy a factory to produce? Will you need to buy manufacturing equipment? Then the 4th, probably the most difficult to come by, is the financing. How are you going to pay for this? You've got this great plan in place. You know how much you're going to sell, what it's going to cost you to do it, where you're going to build your product, how you're going to sell it. Now you have to pay for it. So the financing is really a key component that we're going to talk about in this rest of this module. But first, because I did say that revenues was one of the most important elements of this and really drives the rest of the process, that should be your first step. You have to consider the existing sales volume that you have if your product's already in production, what the demand for your product's going to be, the market penetration and saturation. How difficult is it going to be for you to enter your product? Are there similar products out there already? How quickly will you be able to grow your product? What's a reasonable rate of growth? What's a sustainable rate of growth? Is your product something that a lot of people are going to buy when you first put it out to market, and then that growth is going to fall off until you enter new markets? Or is it something that's going to build gradually and keep going? Once you've determined the amount of revenues, you can look at the second step in this process, which is budgeting your costs. How much do I need to spend in order to meet my sales projections? It's really important to consider all of the costs. You don't want to find yourself into your production process and realizing that there's additional costs that you're going to incur that you didn't expect. Some of the costs that you will incur: facilities. You're going to need a place to produce whatever it is you're selling. You're going to need a format to sell that on. Well, at that place, you'll be there, so you'll probably need a desk, maybe some other furniture for your production staff. If you have a sales environment, you'll have to consider those types of things. Machinery equipment. What will you actually need to manufacture whatever it is that your company makes? The distribution, if you don't have it right there at the same site, are you going to have storefronts? How are you going to sell your product? How many people are you going to need in order to accomplish both the construction of your product and the sales of your product? What are you going to use to build your product? Is your product something in a manufacturing process where there's going to be a lot of inputs? The things that George talked about when he was discussing inventory. Other inputs: insurance costs, the cost to repair the equipment and machinery and the facilities that you're working out of. Utilities, marketing and advertising. You're going to have to get the word out about your product and incur costs doing so. Do you need to travel? Will you only sell here in-state, or will you be selling across the country or even across the globe? Those travel costs could build up. Office supplies are another consideration. You'll need paper and pencils, other supplies, computers, equipment. It's really, really important to consider all of these costs throughout this process because, again, you don't want to get caught surprised by costs. There's some unique considerations when we talk about costs, too, to think about. Workforce. How are you going to pay your workforce? Well, you can certainly pay them with cash, but most businesses, when they're first starting out, are a little cash strained. So there's other vehicles that you can look into in order to satisfy your employees, such as stock options. Stock options are a great way to incentivize employees to both grow your business because the actual compensation that they get is going to be derived from the success of your business. George, do you have any examples that you can touch on where stock options have been a great tool in order to keep a workforce happy?
Oh, yes, Eric. Actually, there are some keys about incentive stock options and other types of stock options that are offered to companies. What we find in our experience working with small companies is the people that you need to work for you and to drive innovation and improvement of technologies and processes inside your company have some of the same entrepreneurial skills and desires and strategies that you as a business owner have. And in order to incentivize those people, a piece of the action, a share at that, the importance of that ownership stake that they have in the company is critical to those people. There are a lot of different types of plans and well beyond the scope of this course to describe all the different types of stock options that are available. The only caution I would have is that they can have income tax and financial statement ramifications. So entering into any kind of a stock option plan without consulting an attorney and an accountant, I would not recommend doing that because you could get yourself in trouble. But they are critical tools to motivating the types of people that you need to grow a startup company and a startup business to be successful.
Great examples of stock options, George. One thing to consider, an additional hidden cost of stock options can really be the added costs of having them and complying with the financial statements that you discussed earlier. In order to have a GAAP-compliant financial statement, you may have to actually get a valuation, which can be pretty pricey. Now that we've talked about all these costs that you're going to incur, they really boil down and fall into two buckets: fixed costs and variable costs. Fixed costs are the costs that won't increase or decrease within the range of volume. Things like your building, the machinery and equipment that you have, your furniture. Variable costs, on the other hand, will increase or decrease within a range of production. These are the direct materials and the labor hours that are being spent, the utility to have the lights on as you build your product. An example of fixed costs and variable costs, because oftentimes really a lot of the production elements and sales elements that you'll be going through will incorporate both fixed and variable costs. So think of a photocopier. The actual cost of acquiring the photocopier is a fixed cost because no matter how many copies you make on that photocopier, it's sitting there in the room with you. The variable components of the photocopier costs consist of the paper that you use, the toner, and other costs that vary based on the number of copies that you manufacture. Now that we've talked about both revenues and expenses, we'll get into the meat of the presentation, which is financing. Financing can be very, very difficult for a startup company because you have to find folks who are willing to lend you money. There's three main ways that you can get money through financing. There's debt financing, equity financing, and financing your business through operations. Third one can be a little hard in the beginning because you're not selling anything yet. You have to usually get money from the other two sources. First, let's talk about debt financing. This is borrowing money. There's three typical types of debt financing that we're going to talk about today: conventional, convertible, and hybrid. Conventional debt financing is what you think of when you think of going down to the bank and getting a loan. It can be a term loan that you'll repay evenly over a period of time, or it can be a line of credit. A lot of businesses have lines of credit, even if they don't draw on those lines, so that they're available in case you ever need them. Generally speaking, this type of debt has variable interest rates. Variable interest rates can be a little bit risky because you don't know what the market's going to do. If the rates rise, your debt payments are going to be larger, and it's difficult sometimes to meet those debt payments. So what a lot of financial institutions will let you do, since they can't let you enter into a fixed rate loan to start with, is they can enter into a swap agreement with you. A swap agreement is a separate agreement, but it's related to your debt. It ties in the interest rate. Basically, it lets you fix your interest rate, which can be really beneficial. One thing to consider, though, with a swap is that a swap is an asset or a liability, depending on the way the market is performing. And because it's an asset or a liability that will change from balance sheet date to balance sheet date, it's also going to have an income statement effect. And that income statement effect can affect your bottom line, which can really play havoc with some of your financial ratios. In order to avoid that from happening, there are some really key accounting considerations that you'll want to look at before you enter into that swap agreement. So it's important to consult a CPA firm or an expert in this area so that you don't get yourself into trouble and you're able to keep those swings, which can be rather large at times, out of your bottom line. The next type of debt financing that I like to talk about is convertible debt financing. This is typically done with private individuals rather than banking institutions. They're, generally speaking, short-term loans, sometimes referred to as bridge loans, while they also can be a little bit longer term. But these bridge loans generally will require principal and interest payments. The timing of those payments can differ very, very greatly depending on the individual who enters into the debt agreement with you. The payments can be deferred and the principal and interest balance can grow so that you can use that money only to finance your operations and repay it later, or they can require that you pay along as you go, similar to what your traditional bank loan would be. The interest rates on these types of loans generally are a little bit higher than conventional bank loans because typically there's a little bit more risk involved. These are the loans that you oftentimes do see with startup companies. Convertible debt is convertible because it's convertible into shares and equity interest in the company. It can be convertible into common shares or preferred shares. It can be convertible into different classes of common or preferred shares, and different features can trigger that conversion. Those features could include the holder of the debt being able to convert at any time that they choose to, or the company being able to control that. Most convertible debt agreements also have provisions that require conversion upon certain events. If your company goes out for a public offering, usually that'll require the conversion so that the holder of that debt's able to participate in the benefits of that offering as well. Hybrid debt financing, generally, this is the type of financing that's generally required by angel investor groups. These are the folks that come in, and really there's a lot of additional, what we'll call sweeteners, added to your traditional or convertible debt. So really this is kind of just the first two that we talked about with a little bit of extras built in. So an angel financer might require, in addition to entering into a debt agreement where you'll pay them back the principal balance of the loan and interest, they'll require some other instruments such as warrants or other equity type instruments that just sweeten the deal for them a little bit. This is important for them because what it will allow them to do is actually get a little bit larger ownership interest in your company. There's some really key accounting considerations to take a look at here too as you're structuring these contracts, because some of the sweeteners can really make you incur a lot of additional costs. In order to properly account for convertible debt with detachable warrants, you're going to need to get a business valuation. These can be very costly and use up a lot of these resources that you're really working hard to garner. Next type of financing that we're going to talk about is equity financing. This is your typical couple people get together to start a business. You contribute capital into an LLC, buy shares, common shares or preferred shares of a company. This is the actual ownership of a company. Next way that we can raise money is through the actual operations of a company. Like I said, this can be a little difficult because at the first part of your business, especially before you have a product, you're not really able to sell much of anything. And really relying on your existing operations to generate financing to fund those operations isn't necessarily the greatest idea. So it's typically a secondary source of financing. Much like George talked about on financial statements, there can be internal and external forecasts. The internal forecasts, again, would be prepared by management and would be made available to your investors or your creditors. A lot of times what you want to do there is use an Excel model, something that will let you build some variability into it so that you can change your assumptions. At the beginning of my talk, I told you that this is going to involve a lot of assumptions on your part, and those assumptions will change as time goes by. A model that lets you really go in and modify itself will help you a lot on the back end and save you a lot of time. You can also have an external forecast. Same types of tools you'll need in order to prepare the forecast, but this time, much like the external financial statements, has a little bit of extra credibility because you'll involve a CPA firm to help you prepare that.
Okay, well, thanks, Eric. So in closing everything up, basically, hopefully we've done a pretty good job of explaining to you, the basic uses of the financial statements and what their purpose is, giving you some overview of forecasting methodologies and some strategies to forecast your revenues and expenses. Over the years, we've helped many, many, many small companies and larger companies with their forecasting needs. As Eric mentioned earlier, key to this process is that build your model with as many assumptions and flow-through assumptions as you possibly can, because this is not likely going to be a one-time process for you. Our clients build the models and then they use them year after year after year. Even after they're up and past the financing and investing stages and they're in the operating stages, they are wonderful budgeting tools. And so we really recommend you spend the time up front, set it up, make it as flexible as possible. Everybody can use Excel these days, and that's what these things are built with. And it really, really will become a useful, helpful tool to running your business. So in closing, I'd like to provide you with a couple of useful websites that might be helpful in starting this process. www.usmetoolkit.org, sba.gov, and score.org. All three of those could be very helpful in giving you the information and things that you need, templates and some other tools to get started in this process. And the key is just to go ahead and get started. The sooner the better.